more Fed reaction, we are joined by Jordan Jackson, JPMorgan Asset Management Global Market Strategist. He's with us here in studio. We've got RJ Gallo, Federated Hermes Senior Portfolio Manager, and Sarah House, Wells Fargo Senior Economist. I have to remind myself, it's like the Greek god, not like the French fashion brand Hermes. Let's start with you, Jordan, here with us in the studio. So it does seem like indeed we got the so-called hawkish skip or hawkish pause we were looking for. But with that summary of economic projections, maybe even more hawkish than we would have anticipated.
I think this is very hawkish. I mean, the idea that the dot plots have moved up to include about 2 more rate hikes coming from the Fed. I think now you're going to start to see markets maybe projecting, if the Fed wants to get close to be done soon, maybe 50 basis points at the July meeting to get us there. That may start to begin to feed through to market expectations. It's been interesting. The statement looks almost identical to May. I mean, they continue to cite that inflation remains to be a concern. Job gains have been robust in recent months. And when I look at the other points of the SEP, they're calling for that soft landing and a slower trend towards inflation getting back to 2%, needing this more hawkish tone. But I think this is very hawkish. I don't think they need to keep raising rates. I think they should be done. Where there's still stresses in the banking system. I think we'll start to see labor markets begin to roll over in the next couple of months. But they've completely pushed back on the notion of any rate cuts happening on the back half of this year, given that they're solidifying further rate increases are likely to come.
And so much of this is going to be about the messaging coming through in that press conference. You talk about you don't think there's a need for additional hikes, and stress in the banking system certainly going to be coming up in the press conference as well. I mean, can you talk about that very delicate balancing act the Fed now has to toe in the messaging here, essentially making it clear to the markets we're not done yet, even though we skipped, and yet we are aware of these other stresses that could materialize even further?
Well, I think they continue to see the hard data, which continues to be relatively firm, even though the survey data continues to roll over, be very weak. When you look at ISM services PMI, when you look at services of business confidence going forward, again, the survey data suggests that the economy is likely to come under a bit of pressure. They just aren't seeing it in the hard data yet, so that suggests that they think they've got to do a little bit more. But I have a real issue with the Fed continue to be backward looking. Right? Especially when I think about the labor market, that's always the last shoe to fall. Once the labor market breaks, that's when you're in the recession, right? That's the definition of the recession. But we're seeing signs that I think the labor market will start to come under pressure. I think claims data tomorrow morning will be particularly important. You're seeing a fall off in the quits rate, a rise in the layoffs rate. Those are typically precursors to a bit of weakness. And so, again, I think the Fed should be done. I think further hikes, especially 2 more hikes potentially, is overdoing it.
Sarah, I'm curious to get your take here, not just on what the Fed is doing today, but what all of this implies about the likelihood of a so-called soft landing and the likelihood maybe, could we actually avoid a recession? Is that what is implied here, and is that correct?
Well, I think that's certainly in the SEP in terms of their projections, where they still have some pretty favorable growth rates. Although I think in some ways it doesn't quite jive with the unemployment rate projections that they're looking at. We're still talking about more than a 1 percentage point rise in the unemployment rate, which is going to take, I think, a good deal of job losses, considering just the inflows of labor supply, just given the demographic backdrop. So I think, overall, the SEP is still signaling that soft landing is possible. We just need a few years of below trend growth, and that you'll see inflation slowly come down, a little bit more slack in the labor market. But I think in some ways the GDP forecast and the unemployment rate forecast don't quite fit.
RJ, you agree?
I think Sarah makes some good points. I mean, the Fed is sending a little bit of a hawkish pause here. And in that sense, I think it confirms the market's expectation. They're revising up growth, revising down unemployment. That said, unemployment will still rise materially from here, according to their dot plot. To be frank, I think that the Fed is trying to pull off something that's a little difficult right now. You have the FOMC statement. As Jordan mentioned, it hardly changed. The dot plot is a powerful communications tool, but it moves. It's a projection. It's not promises. I think the key here is what does Chairman Powell say from the podium? Is he going to be able to sort of embrace the hawkish message that we already see? Or is he going to modify it and soften the tone? There has been a tendency for the statement and the dots to send one message, and then Powell at the podium sometimes takes a slightly different angle. So what we really have to see what he says here, because he's trying to explain why they're pausing, even though they open the door to potentially more hikes if needed.
RJ, I'm looking at the CME Fed Watch, as I like to do. It moves a lot, to be clear, but it prices in where the market thinks the Fed is going to be. And there's a lot of diversity of opinion being reflected there, right? So right now, the odds are running at about 43.5% that there will be no more movement up or down in rates. But there's about a 20% chance being priced in of a cut. About a 30%, a little more chance being priced in of another quarter point hike. So it seems like, as you say, the market's kind of taken the dot plot with a grain of salt here.
Yeah, well, the dots have proven to be a means of communication. They have not been a very accurate projection. Go back to the beginning of this extraordinary hiking cycle. The Fed did not predict that we would be where we are today, 5.25% to 5.5%. That's why the market is looking at the dots and taking them with a grain of salt. They need to be viewed that way. I still think they have a powerful role, however. In any forum of life, if there's a committee making a decision and they will provide projections about what they think they will do, wouldn't you want to know what they thought? That's what the dots are. They're not promises, they're projections. Right now, the Fed is telling us they think they might have to tighten a little bit more. And then they're telling us we'll probably ease next year. That helps to allow the Treasury yield curve to remain inverted as it incorporates this concept of easing in 2024, which it was obviously in the market before anyway. And as a result, the dots give the Fed some forward-looking projection tool that otherwise wouldn't come across as coherently. And I think that's partly why this rate hike cycle has been pretty extraordinary and how you can have such a deep inversion. Because in most periods of Fed history, you didn't have the dots. You've only had dots for a couple of tightenings. And if you go back to the dots in prior tightenings, dots came along in 2012, what you'll see is the Fed did not forecast eases in the prior projections that they made back, 5-6 years ago. They have consistently been doing so here. And so the market looks at the dots with a grain of salt, but does take into account the directional communication that's coming out of them. The idea that we hike now, we hold, and we'll probably ease. Of course, they move around a lot despite that overall view.
So Jordan, as we see this sell-off in stocks, and we know following these Fed decisions and during the press conference, we can get some volatility. Is what just happened negative for equities?
Well, I think the market reaction is basically saying you can't keep hiking rates forever, right? Stock prices have got to, be reflective of the rate environment. If they're going to keep hiking rates, then it's kind of hard to put a valuation on the market, a forward P on the market of 18.5 times. Especially if you think the earnings outlook is maybe not as rosy as currently what analysts are currently forecasting. It's just hard to put a multiple if the Fed is going to keep going here. So I'm not surprised to see markets are selling off, not just from an equity perspective, but from a aggregate demand perspective. If the Fed keeps hiking rates, this is going to continue to weigh on the banking stresses that we're seeing across regional banks. I think some of the economic projections aren't in line with a higher Fed funds, but also higher inflation expectations. I'm not really sure what forward inflation outlook the committee members are looking at. We're anticipating a 3.5% handle on inflation by next month. Remember, in June of 2022, month-over-month energy inflation was running at 6.9%, month-over-month, 7%. The last 2 months, used vehicle prices have risen by 4.4% in the last 2 months. Those things, base effects in energy, normalization in used car prices. I've found interesting the new index that the Cleveland Fed and in joint with the BLS, the new tenant repeat rent index, which now looks to be more closely tracking what we're seeing in terms of rental inflation, suggests some pretty significant disinflation coming from owner's equivalent rent over the duration of 2023 and into 2024. So you've got all these indicators, right, that suggest that inflation is heading back down and suggesting the Fed doesn't need to do all this extra hiking. And so, something's going to break here. And so I'm a little bit more worried. And I think stocks are a little bit worried as well.
Yeah, RJ, let me get your thoughts on how we're seeing the market react here on the back of this Fed decision. I mean, how much of this move to the downside is justified given what Jordan just highlighted?
I think it's interesting. Jordan said we're going to see something break. We already sort of did see something break. SVB, Signature Bank, emergency lending facilities that were put in place to help to relieve a stressed banking system amid the greatest monetary tightening in 40 years. We've seen some things break. And I think the Fed in this message is suggesting they need more time to see the implications of those banking sector stresses. Nevertheless, they took the opportunity to signal in the dots that they'll tighten more. I would argue that the dots are sort of serving their purpose as a communications tool here. They must perceive that enough of the FOMC members must perceive that there's a risk that inflation just doesn't cool down enough, despite all the signals that Jordan mentioned, and I would echo that there are plenty of signals out there that inflation's on its way down. It's still too high relative to a 2% target, however. And I think the Fed might be trying to send us a subtle message here. They're pausing right now. They might be a skip, but they'll tell you if they had to move, they would tighten again. The dots are not promises. These can change again, but I think it fits their purpose to suggest that they have a hawkish lean so that the bond market doesn't start some huge rally and that the stock market also doesn't start some huge rally, which otherwise would occur if you said, hey, we're pausing, let's see what's next.
Well, and on that front as well, Sarah, the stock market rallying is also one of the things that might make the Fed more likely to continue to tighten because it's sort of one measure of financial conditions loosening instead of tightening, right?
Right. So I think what's been in some ways the big surprise here with the Fed deciding to pause, skip, whatever you want to call this meeting, is that we've seen financial conditions ease since the last meeting, and they're also down since the start of the year. And so I think in some ways this was a signal that, okay, we're not gonna come through with a surprise. We are going to assess how the data unfolds, but we're still looking for those financial conditions to tighten. And so in some ways the surprise came through that dot plot with a bigger increase in terms of that median projection for the end of this year. So signaling that it's likely that we could see even more rate hikes than what was generally expected coming into this. So perhaps just a bit of a signal that maybe not a surprise at this particular meeting in terms of the outcome, but certainly ready to tighten financial conditions should it prove warranted, which, based on a variety of financial conditions indexes in recent months, it certainly seems to be.
So that's the read from the Fed, Sarah. But I'm curious how you read the most recent data that came out. To Jordan's point, there are already signs here that we are seeing things move in a disinflationary, basically cooling down in terms of where the price pressures are. I mean, do you agree with his, at least thesis, that the Fed is a little behind the ball on this?
So I'd agree in terms of we are seeing economic activity slow. I think the pieces are certainly in place for further and in some ways more market disinflation here in the coming months. But I think that moving in the right direction isn't the same as assuredly being back towards where the Fed wants to be in terms of inflation. So overall, we've seen economic activity be incredibly resilient, not just through this year, but over the intermediate periods. We've actually had economic surprises over the past month or so have been by the widest margin in about a year and a half. And when you also combine it with the inflation outlook, yes, we are looking at slower price growth ahead, but core inflation is still running roughly 2 times the Fed's target. And this is a Fed that talks about they want to make sure it's on a sustainable downward path. And we just haven't seen that quite yet.
So I think it's interesting. We're now at, if I'm right, and we get another downward move in inflation next month, that'll be 12 consecutive months of inflation continue to come down from its peak last month. I also think when you look at the lending environment, the tightening in overall lending conditions, there's a pretty close correlation between, if you look at the NFIB survey and take the availability of credit and the expectations of credit conditions going forward, that leading to a rollover in the labor markets. Now, again, the hard data, the labor market data is a lagging indicator, right? And so that's going to be the last shoe to drop. And so I think it's really important for investors to look to see what are sort of the trends coming out of the labor market. And so, it's looking at average hours worked. I think, again, that NFIB survey that suggests that credit conditions can continue to cause tighter conditions. And I try to remind investors, 52%, a slight majority of the private workforce is employed at a business that has 500 or fewer employees. Many of these small businesses bank at regional banks. And so you can see an environment in which they're now having to tap those business lines of credit, recognizing that short-term business loans have gone from 4% in July of 2020, now sitting at north of 8% today. It's almost doubling. The availability of credit have become more restrictive. And so they're going to have a real tough challenge, and I'm going to have a tough time rebuilding inventory. I'm going to have to lay off staff. And that's how you get this tighter credit conditionings broadening out to the labor market.
Well, what does that suggest in terms of what could be waiting on the other side of these 2 additional hikes from the Fed?
And that's the real challenge, because these regional banks are still dealing with issues both on the liability side as well as on the asset side. And that's leading into further tightening in lending conditions. And so if now I'm able to get 5.5% potentially, or north of 5% on a money market instrument, why get a couple basis points in my savings account? Also, higher rates are going to continue to weigh on property values. We know regional banks have outsized exposure to commercial real estate. That's going to continue to be a challenge on the asset side. And so, this is, I think they should be done. I think they've done enough. I think there are clear trends that the labor market's going to start coming under pressure. We're already seeing the disinflation beginning to feed through. And I think adding more rate hikes. And again, I know, RJ, as you highlighted, this is just a projection, not a promise. But I think it's signaling to the market that rates are going to be higher for longer. We want to see more tightening in financial conditions, given the loosening that we've seen as of late. But I think it causes more damage to the economy.
Well, Sarah, I mean, isn't this just, in some ways, this is a method that the Fed has, right? If the market believes it's going to continue to raise rates, it doesn't necessarily have to continue to raise rates, right?
Right. So it's a little bit of a game back and forth between this communication and using that as a tool itself. But as we've seen, these can change pretty quickly in intermediate periods. And so in some ways, I think it's just the Fed's going to have to keep at it with some of this hawkish talk. And I think at some point you'll have to see that hawkish talk backed up with potentially another rate rise. And we think we will get one most likely here in July.
It's worth noting we are about 5 minutes out from that press conference starting. We'll, of course, have that live for you here with Fed Chair Jay Powell speaking after this no decision, essentially, or pause from the FOMC today. RJ, from an investment standpoint, what does that mean? And we've been talking about what the market's reaction is today, but how do you think about going into year end, especially if the expectation is for 2 additional hikes from the Fed?
Well, in the fixed income side of Federated Hermes, we've been leaning a little longer duration in our portfolios. That might be surprising to folks when you consider that the short end of the curve yields have continued to back up, and they've 2-year yields, for example, are up, I think, like 23 basis points in relatively short order here. But the long end of the curve hasn't risen all that much. We've been extending duration because we believe the more the Fed does now, the deeper the recession they will cause later. So the curve can stay inverted. And I think the Fed's dots just blessed that again today. Extending duration may mean that you're going to get a little lower yield than what you get in a money market fund. And we have plenty of those in my company, so you can stay in that if you want. But I think ultimately, by extending some duration, you're positioning yourself for the next chapter of this book. The next chapter is when the economy slows due to the many headwinds that have emerged and will likely intensify. And the Fed finally says we've done enough on inflation. We are going to start to ease to try to avoid too deep of a downturn. Once that, even a sniff of that is sensed by the market, bond yields fall, you get price appreciation, and your intermediate bond portfolio will outperform your money market fund at that point in time. Calling the exact turn and cycles is very hard, but now that we are at a point where the Fed has tightened 525 basis points, where unemployment has already started to rise, when we are well past peak inflation, I think now is the time to leg into some longer duration positions within your individual portfolio. We've done that in our portfolios. We actively manage all our bond funds, and we've extended duration to be long of our indices in order to take advantage for that development that we anticipate, that ultimately we're going to get some price appreciation in bonds. We're getting closer to that day.
All right, we're less than 3 minutes out until the press conference, but RJ, I just want to say one thing here, which is that everybody's been talking about this recession for what seems like forever. And I know you said it's hard to time it, but like, when is it? I mean, this year, next year? Is it really coming? Is it really going to be that bad? It just seems like it just keeps getting pushed out.
It does keep getting pushed out. I would suggest the recession we're going to see is one that may actually resemble what happened back in, say, 2000, 2001. You might remember that was the dot-com bubble bursting. There were many financial market implications, negative ones, from that. A lot of interest rate sensitive segments of the economy slowed down, but consumer spending, roughly 70% of GDP, never went negative. It's quite possible we'll see that same dynamic in this coming recession. That means the recession's apt to be somewhat mild. If consumers who right now are abundantly employed, the unemployment rate is at 3.7%. That's just off the lows of the last 53 or 54 years. If it does rise up north of 4, which I think is a reasonable expectation, the Fed certainly signals that in their summary of economic projections today, it's possible that consumers will still have enough disposable income, will still have enough employment in the economy that the C in the GDP accounting, consumption, doesn't actually contract. In that case, it's a more mild recession, and the Fed is not returning to a zero lower bound. They're easing maybe 50 or 100 basis points, not 500 basis points, undoing what we just did. So the timing of recession, I agree, it's key. In this business, if you get your timing wrong too often, then you're just wrong. But I think ultimately this recession is coming. It's apt to be a mild one, and will ultimately be friendly to investors who are adding some duration now and in the next couple of months.
Really quickly, Jordan, as we count down to Jay Powell's press conference here, what do you want to hear from the Fed chair?
I'm hoping he adopts sort of, and he's been great at this, a bit of a bedside manner and striking a bit of balance. I think he needs to, be careful and not to sound overly hawkish and overcommit to these additional rate hikes and recognize that, acknowledge that, yes, inflation's still high, but it's working its way down. He'd made that very clear in his last conference that, we are already in the disinflation process. I think he needs to reiterate that message, but maybe strike a little balance. And I think primarily the Fed has been so focused on pushing against rate cuts in the back half of the year that almost to some degree, the talking up of rate hikes at the front end continues to push back against the notion of rate cuts later on this year. And so I think he should maybe emphasize that message, but he's got to strike a little bit of balance. There are still risks that are very prevalent within the economy. Inflation is, again, as we talked about, is showing some signs of abating. So I think he's got to strike a bit of balance at the press conference.